Alrighty, time for another dollar dialogue. And this week we're talking to someone who was on this podcast back in April, and his savings tip back then was to buy gold. Now, I really wish I'd taken up that tip, because since then, the price of gold in Aussie dollars at the time of recording is still up about 20% despite the recent dip. So I am, of course, referring to HSBC Australia's chief economist, Paul Bloxham, who joins us now. G'day, Paul. Welcome back to the Savings Tip Jar.
Thanks. It's great to be here.
Thanks for joining us, Paul. As Don mentioned, your savings tip last time, coincidentally on April Fool's Day, was to potentially buy gold. Is that still your savings tip?
Well, when I look at the forecast that we've got at HSBC for gold, we still think gold prices have got a bit of upside running into next year. We've got an average price that we're looking at that's 4,600. So we're at the spot price for gold, as you say, has dropped a little recently, and it's below that level. So I still think there's some certainly the forecast implies a little bit more upside, but we're partway through the run, right? I mean, the gold price has risen a lot already, and we also know that, if you look back through the history of gold, it can move quite quickly. In fact, we've just seen a really big move just in the last day's trading in gold prices. So while it's still a positive story, we're partway through that run. The forces at work that are supporting gold, some of them are quite fundamental. I mean, it's global uncertainty, it's concerns about the outlook for inflation, it's concerns about Federal Reserve independence. A lot of these things are things that are going to be around for a while. So I think one thing you can say, or we do say, is that gold prices are going to remain elevated relative to history over the coming period. But how much more topside? Well, we'll just have to see.
Yeah, I wanted to know, Paul, how much of this growth in the gold price is just purely hype? Are people just following the crowd, seeing lines out the door in Martin Place outside the gold trading store there, and just trying to follow the crowd and get on the train there, versus the actual, real sort of, economic uncertainty element? Because, of course, gold is the original currency. When people suspect economic troubles, they'll flock to gold. It's a hedge against a lot of things. What portion of that is hype? And also, while you're onto it, what's driving the recent slide that we're seeing? Obviously, quite sharp drops happening at the moment.
So I think it's both stories. I mean, this is where it gets challenging. There are some good fundamental reasons to believe gold prices should remain elevated relative to history. And of course, we've hit all-time highs in the past couple of weeks. We had a run of hitting all-time highs for a number of weeks. And so you can see some fundamental forces at work that are supporting it. Concerns about the independence of the Federal Reserve, concerns about a very uncertain global policy backdrop, concerns about inflation potentially picking up in the medium term, in part because of those features as well, and somewhat of a move away from holding as many US dollar assets into something else. And what can that be? Well, gold is collecting a lot more of that flow. Central banks around the world have been accumulating more gold in recent times. So there's some pretty solid fundamentals that underpin the idea that gold prices should be high and should be much higher than they've been in recent years. But, of course, when you get any asset price like gold prices going up as quickly as they have done over the past few months, you're also attracting now a retail element. You're also attracting a speculators element to this story. And so that's been a contributing force in recent times as well. And I think your question about, what's moving it, sort of what's seen the correction we've seen in the last sort of little while, I mean, that's part of the answer. Part of the answer is there are some fundamentals that are driving it, but finding the right level as to what the gold price is going to be is not that, and revealing it is not that easy. And a part of it is investors getting sort of caught up in it and pushing it higher, and then there being some corrections along the way. I think volatility is certainly going to be a feature of the story as well.
Now we'll turn our eye to the share markets. It seems like, traditionally speaking, before COVID, gold rose, and then as share markets were falling because it was seen as a hedge, and then vice versa. But now it seems like share markets are at or near all-time highs in most sort of major markets. Can you explain why that's going on?
It's very unusual, as you say, and you're hinting at that these correlations normally work the other way. The historical longer-term correlation tends to be the case that when you get a risk-on environment, investors are very confident about the future. They tend to drive themselves into risk assets like stock prices, and we see that driving equity prices higher, tend to move away from what are seen as more safe haven assets like gold. And so the correlation tends to be the opposite of what's going on right now. I mean, I think the best explanation is that at the same time that investors want to hold high-grade corporates and they're driving the story there, and a part of what's driving up the equity market is expectations of improved productivity around the world, in part because of the AI story. So at the same time that they want to hold more risk assets, there is a caution about wanting to hold more US dollar denominated assets. And so that's seeing this sort of combination that's a bit unusual at the moment, where both gold prices and equity prices have been rising together. Now, some of those correlations may very well start to reassert themselves, and maybe just in the last period where we've seen gold prices come down, that might be a sign that those correlations, which hold in the medium term, might start to be a feature of what's going to drive things going forward as well.
Cool.
And now turning our eye to, I guess, what we could call the Aussie gold standard, property. It seems like another sort of safe haven storage and investment alternative to gold. Where do you see that going? And that kind of, I guess, ties into the central bank potentially cutting the cash rate in November.
Yeah, absolutely. So we've seen property prices start to pick up pace in Australia for most of this year. It's a broad-based story. It's not just happening in any one city. It's happening across the country. And so one of the stories there, of course, is that interest rates have already come down. The RBA's already delivered 3 interest rate cuts. They've cut in February, they cut in May, they cut in August. They've delivered 75 basis points of easing. Now, it seems quite sort of extraordinary, though, that even only a modest easing in monetary policy has driven prices to rise across the country, and they're gaining momentum. And so a part of this story is simply that we are pretty heavily supply constrained. We just haven't got enough housing. We haven't been building enough housing in recent years. This goes to the productivity story, which is that Australia's got quite weak productivity. We just haven't been able to build that much across the board, but in particular in the housing sector. So if demand picks up and it hits an economy that has limited supply, that tends to put upward pressure on prices, and that's what we're seeing in the housing market. So I think that's a feature that's going to continue to see house prices rise into 2026 as well. We've got pretty solid house price growth expected into 2026, again, across most of the capital cities. And one other feature may very well be, and certainly our central case, that the RBA may get to deliver a little bit more monetary policy easing yet. There's a big question around whether they do cut further this year or whether it's next year. But I think if you look across the set of analysts and you look at the market pricing, there's a fair bit of confidence that the next move for the RBA is still down, and that the next move is likely to be, so the next move is the RBA delivers a bit more support. So that ingredient, pouring more fuel into the story, I think it's I'm pretty confident that house prices are going to continue to rise through 2026.
Yeah. Now, Paul, we'll just focus more on the RBA in November. So we saw analyst views are all over the shop generally. And we saw after July's sort of weaker than expected inflation results in the monthly indicator, a lot of, pundits changed their views around saying, yes, there will be a cut in July. That didn't happen. The RBA said, no, we're focusing on the quarterly result. And then it seems like more of the same happened with the latest monthly inflation indicator. That was stronger than expected, and now they're saying no cut in November. Then, off the back of that, we saw weaker than anticipated labour force data at, I think, 4.5%, which is a bit higher than anticipated. Can you just cut through all of that and make sense of, why the RBA is not looking at the monthly inflation indicator, where we stand with November, the likelihood of further cuts next year, and so on?
I think you're right that there's a lot of ups and downs, and it's actually quite a complicated picture to explain. I think that a lot of analysts, and I think the RBA too, have put quite a lot of emphasis in the last month or so on the reading we got, the last reading we got for August for the monthly CPI indicator, and reading into that actually they're expecting that they may get a higher inflation print in that third quarter print, the all-important one that comes out on the 29th of October. And with that, the RBA sort of delivered a cautious message that maybe we shouldn't expect interest rate cuts to come through because they were a bit worried about that upside surprise to that monthly CPI indicator. Our own view is there's not actually that much information in that CPI indicator. It's a really volatile, partial, incomplete measure. And if you sort of stretch it to its best, I think it's hard to convince ourselves that actually there's much of an upside that's going to come through that quarterly inflation print. And then, as you say, the whole market got another sort of shift in the other direction when we got these softer employment numbers for September, where employment was more sluggish than expected, and also the unemployment rate jumped to its highest level in almost 4 years, and the market then started to sort of move back towards the idea that the RBA might cut in November. Now, critically, what's going to matter is what that third quarter trimmed mean CPI print looks like in terms of the actual decision that comes in November. Our own inclination is that it will still be low enough, and the weakening of the labour market that we've seen in those jobs figures will be enough to get the RBA over the line for delivering another cut in November. But a lot of it's going to hang on that CPI print. In fact, that's the thing to watch at 11:30 on the 29th of October. That CPI number is going to really be the key deciding factor as to whether the RBA cuts again in November. Now, if they do, then that's our central case, and that's going to support a bit more growth in the economy. If they don't, because inflation's a bit more on the upside, I still think the next move for the RBA is still more likely to be down than up running into 2026, in part because the labour market, the jobs market, is loosening a bit more quickly. We are getting a little bit more spare capacity in the labour market. So either way, I think we're looking for the RBA to be delivering more cuts going forward. The question is just, will they get over the line for delivering that in November? And a lot of that's going to hang on that CPI print that we get.
For sure, yes. Fast becoming Australia's blood sport, the economic data coming through. And I guess, time will tell, Paul. As you said, in about a week from now, we'll know which way the wind blows. Thanks so much for joining us on the Savings Tip Jar podcast once again.
Thanks, guys.